Investing can be confusing. Two popular choices are ETFs and index funds. They can help you grow your wealth over time, but many people aren't sure which one is right for them. We're going to break down ETFs and index funds in a simple way. You'll learn the key differences between these investment options. By the end, you'll know which one is best for you. Whether you're just starting out or have some investing experience, this video is for you. Are you ready to take control of your financial future? Let's dive in. Let's start with index funds. Imagine a basket of stocks. This basket represents a specific part of the stock market. This could be the entire stock market, like the S&P 500, or it could be a smaller part, like technology stocks. An index fund buys all the stocks in that basket. It tracks the performance of that specific market index. Think of it as investing in the whole basket instead of picking individual stocks. Index funds are a type of mutual fund. They are managed by big financial institutions. Vanguard is a well-known example of a company that offers index funds. As the market grows, so does the value of your investment. One of the biggest advantages of index funds is diversification. This means you're spreading your money across many different stocks. Diversification is crucial for managing risk. If one stock performs poorly, it won't sink your entire portfolio. With an index fund, you're investing in a wide range of companies. This reduces the impact of any single stock's performance. An index fund gives you exposure to hundreds or even thousands of companies. This diversification helps to smooth out your returns over time. This is especially important for long-term investors. Index funds are known for being low-cost investments. They have low expense ratios. This means you pay a small percentage of your investment each year to cover administrative costs. Lower fees mean more of your money is working for you. Another benefit is simplicity. Index funds are easy to understand. They follow a straightforward strategy track a specific market index. You don't need to be a stock market expert to invest in index funds. They provide a simple and effective way to build wealth over time. When you buy an index fund, you're buying a small piece of the overall fund. The fund manager uses the money from investors to buy the stocks in the underlying index. The price of an index fund share is determined by the net asset value, or NAV. Index funds are typically traded once a day. This is different from stocks, which can be bought and sold throughout the day. The price of an index fund is updated at the end of each trading day. Many investors choose to invest in index funds regularly. This strategy helps to reduce the impact of market volatility. Now let's talk about ETFs, or exchange-traded funds. Like index funds, ETFs are designed to track a specific market index. This could be the S&P 500, the NASDAQ 100, or even a basket of bonds or commodities. But there's a key difference between ETFs and index funds. ETFs trade on stock exchanges, just like individual stocks. This means you can buy and sell ETFs throughout the day. Their prices fluctuate in real time, reflecting market demand. ETFs offer the diversification of index funds with the flexibility of stock trading. One of the biggest advantages of ETFs is their trading flexibility. Unlike index funds, which trade only once a day, ETFs can be bought and sold throughout the trading day. This allows you to react to market movements and take advantage of opportunities as they arise. This flexibility makes ETFs a popular choice for active traders, but they're also suitable for long-term investors who want more control over their investments. ETFs also offer greater liquidity than index funds. Because ETFs trade on exchanges, they tend to be highly liquid. This liquidity can be especially important during times of market volatility. Another advantage of ETFs is the sheer variety of options available. You can find ETFs that track virtually every market sector, industry, and asset class. Want to invest in technology companies? There's an ETF for that. How about renewable energy or emerging markets? There are ETFs for those too. This wide range of choices allows you to create a diversified portfolio tailored to your specific investment goals. You can choose ETFs that align with your risk tolerance and time horizon. Trading ETFs is very similar to trading individual stocks. You can buy and sell ETFs through most online brokerage accounts. When you buy an ETF, you're buying a share of the overall fund. The ETF provider uses the money from investors to buy the underlying assets, such as stocks or bonds. The price of an ETF fluctuates throughout the trading day, based on supply and demand. Many online brokers now offer commission-free ETF trading. Alright, we've covered the basics of index funds and ETFs. Now, let's dive into the key differences between these two investment vehicles. And the first difference we'll tackle is trading. With index funds, you can only buy or sell shares once a day after the market closes. The price you get is based on the fund's net asset value, or NAV, at the end of the trading day. ETFs, on the other hand, trade throughout the entire trading day, just like individual stocks. Their prices fluctuate in real time based on supply and demand. This means you have more flexibility to buy or sell your ETF shares whenever you want during market hours. Think of it like this. Index funds are like a bakery that only sells bread at the end of the day. That brings us to our next key difference: flexibility. ETFs offer greater flexibility than index funds in a couple of ways. First, their intraday trading allows you to react to market movements more quickly. If you see an opportunity to buy low or sell high, you can act on it immediately with an ETF. Second, ETFs often come in more specialized varieties. You can find ETFs that track specific sectors, industries, investment strategies, or even themes like renewable energy or artificial intelligence. This allows you to fine-tune your portfolio to align with your specific investment goals and risk tolerance. Index funds, while offering diversification, are generally broader in scope. They track major market indices like the S&P 500, which includes a wide range of companies across different sectors. Now let's talk about everyone's favorite topic: fees. When it comes to investing, lower fees mean more money in your pocket over the long run. And in the battle of ETFs versus index funds, both contenders are known for their relatively low costs compared to actively managed mutual funds. However, ETFs generally have a slight edge in the fee department. Because they're passively managed and track an index, their expense ratios tend to be even lower than those of index funds. The difference in expense ratios between ETFs and index funds is often very small, especially for broad market funds. The important thing is that both options are significantly cheaper than actively managed funds, which can charge high fees that eat into your returns. Finally, let's talk about accessibility. Both ETFs and index funds are widely available through most online brokerage accounts. You can easily buy and sell them just like you would with individual stocks. However, there's one area where index funds have a slight advantage, particularly for beginner investors. Many index funds are eligible for fractional shares. This means you can buy a portion of a share if you don't have enough money to buy a whole share. This is especially helpful for investors who are just starting out and may not have a lot of capital to invest. ETFs, on the other hand, typically require you to buy whole shares. However, many online brokers now offer fractional shares for ETFs as well, making them more accessible to a wider range of investors. Now that we've explored the ins and outs of ETFs and index funds, you might be wondering, which one is right for me? Don't worry, we've got you covered. Choosing between these two investment powerhouses doesn't have to be overwhelming. It all boils down to your individual needs, goals, and investing style. Think of it like choosing between two great restaurants. Both offer delicious food, but one might be better suited for a casual weeknight dinner, while the other is perfect for a special occasion. Similarly, both ETFs and index funds can help you grow your wealth, but one might be a better fit for your particular financial palette. The first step is to honestly assess your investment style. Next, consider your investment goals. What are you saving for? Retirement? A down payment on a house? Your dream vacation? If you're investing for a long-term goal like retirement and you prefer a hands-off approach, index funds can be a great option. Their low fees and broad market exposure make them a solid choice for steady long-term growth. But if you're investing for a shorter-term goal, or you want more flexibility to adjust your portfolio based on market conditions, ETFs might be a better fit. Their intraday trading and specialized options allow you to be more nimble with your investments. Think about your risk tolerance as well. Index funds, with their broad diversification, generally offer a smoother ride compared to individual stocks. However, they're still subject to market fluctuations. Ultimately, the best way to choose between ETFs and index funds is to consider your own unique circumstances and preferences. There's no one-size-fits-all answer. What matters most is that you're investing consistently and making choices that align with your financial goals. Remember, investing is a journey, not a race. It's about making smart choices today that will set you up for financial success tomorrow. Both ETFs and index funds can be powerful tools on this journey, each offering its own set of advantages. Don't be afraid to do your research, ask questions, and seek guidance from a financial advisor if needed. The more informed you are, the better equipped you'll be to make decisions that are right for you. Popular ETFs, your gateway to diversification. Now that you have a good grasp of ETFs, let's look at some popular choices that can kickstart your investment journey. Remember, these are just examples, and it's crucial to do your own research before investing in any specific ETF. First up, we have VTI, the Vanguard Total Stock Market ETF. This ETF aims to track the performance of the entire US stock market, giving you broad exposure to large, mid-sized, and small companies. It's like owning a tiny piece of every publicly traded company in America. Next, we have SCHD, the Schwab US Dividend Equity ETF. This ETF focuses on high-quality dividend-paying companies with a history of consistently sharing profits with their investors. If you're looking for a source of passive income, SCHD could be a good fit. For those interested in the tech sector, QQQ, the Invesco QQQ Trust, is a popular choice. This ETF tracks the performance of the NASDAQ 100 index, which includes tech giants like Apple, Microsoft, and Amazon. However, be mindful that tech stocks can be more volatile than the broader market. Lastly, for those seeking exposure to the S&P 500, VOO, the Vanguard S&P 500 ETF, is a solid option. This ETF tracks the performance of the S&P 500 index, which includes 500 of the largest publicly traded U.S. companies. Remember, these are just a few examples of the many ETFs available. The key is to choose ETFs that align with your investment goals, risk tolerance, and time horizon. Section 2. Index Fund Favorites. Building a solid foundation. Now let's shift gears and explore some popular index funds that can serve as building blocks for your investment portfolio. Just like with ETFs, it's essential to do your own research before investing in any specific index fund. First on our list is VTSAX, the Vanguard 500 Index Fund Admiral Shares. This fund aims to track the performance of the S&P 500 index, providing broad exposure to the U.S. stock market at a low cost. It's a classic choice for long-term investors seeking steady growth. Next, we have FSKAX, the Fidelity Zero Large Cap Index. This fund stands out for its zero expense ratio, meaning you pay no annual fees to invest in it. It tracks the performance of large-cap U.S. stocks, making it a cost-effective option for building a core portfolio. For those seeking international exposure, SWPX, the Schwab Total Stock Market Index, is a solid choice. This fund tracks the performance of the global stock market, providing diversification beyond U.S. borders. Investing in international markets can help reduce risk and potentially enhance returns. Remember, these are just a few examples of the many index funds available. The key is to choose index funds that align with your investment goals, risk tolerance, and time horizon. Consider factors such as expense ratios, historical performance, and the fund's investment objective before making a decision. Section 3. Platforms to jumpstart your investing journey. Now that you have a better understanding of ETFs and index funds, you're probably wondering where you can actually buy them. Fortunately, there are numerous platforms available to help you get started with investing, regardless of your experience level or budget. First on our list is Vanguard, a pioneer in the world of index funds and ETFs. Vanguard is known for its low fees, vast selection of investment options, and investor-friendly approach. They offer a wide range of ETFs and index funds covering various asset classes and investment strategies. Next, we have Fidelity, another reputable financial institution with a long history of serving investors. Fidelity offers a comprehensive platform with a wide array of investment products including ETFs, index funds, brokerage accounts, and retirement accounts. They're known for their research tools, educational resources, and customer support. For those seeking a more traditional brokerage experience, Charles Schwab is a solid choice. Schwab offers a robust trading platform with a wide range of investment options, including ETFs, index funds, stocks, bonds, and options. They're known for their research capabilities, trading tools, and branch network. Lastly, for investors who prefer a more automated approach, M1 Finance is a great option. M1 Finance is a robo-advisor that allows you to create a customized portfolio of ETFs and index funds based on your risk tolerance and investment goals. They offer automatic rebalancing, fractional shares, and no trading commissions. Remember, these are just a few examples of the many platforms available for investing in ETFs and index funds. The key is to choose a platform that aligns with your needs, preferences, and investment style. Section 1. The Power of Informed Investing. There you have it, folks. We've covered the essentials of ETFs and index funds, those workhorses of the investing world. Remember that feeling of being lost in a maze of financial jargon? Not anymore. You've armed yourself with the knowledge to confidently navigate the world of investing. We've broken down the key differences between these two investment vehicles, from their trading styles to their fee structures. You've learned how to choose the right option based on your individual needs, goals, and risk tolerance. The most important takeaway? You don't need to be a financial expert to make smart investment decisions. With a little bit of research and a clear understanding of your financial goals, you can build a portfolio that will set you up for long-term success. Remember, investing is a marathon, not a sprint. It's about making consistent contributions over time and letting the power of compounding work its magic. Section 2. Embracing the journey to financial freedom. As you embark on your investing journey, keep these key points in mind. Start small and stay consistent. You don't need a lot of money to get started. Even small contributions made regularly can add up over time. Diversify your investments. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographies to reduce risk. Stay informed and stay the course. The financial markets will inevitably experience ups and downs. Don't panic sell during periods of volatility. Stay focused on your long-term goals and ride out the storms. And remember, the most valuable investment you can make is in yourself. Continue to learn, grow, and explore the world of personal finance. The more knowledge you have, the better equipped you'll be to make sound financial decisions that will lead you toward financial freedom.